you. And there's a live picture of the floor of the New York Stock Exchange. We are on the verge of wrapping up one of the worst weeks for the stock market in recent memory. The S&P 500 on track for its worst week in 4 years. Same goes for the Dow Jones Industrial Average. Once again, as we approach this final stretch, stocks are under pressure today. The Dow Industrials right now down about 87 points. Hi, everybody. Welcome to the Closing Bell. I'm Maria Bartiromo coming to you today from Wall Street on the floor of the New York Stock Exchange. Things have quieted down here quite a bit. It's a Friday afternoon, but things have definitely heated up on the downside as far as performance is concerned, with the Dow right now down once again in the double digits. Just about 30 minutes ago or so, it was down more than 100. I will point out one tidbit here, and that is companies are looking at this sell-off as a buying opportunity. Already we have seen so many buyout announcements on the private equity side and so many buyback announcements from corporate America. Thomson Financial tells me that they track more than $56 billion in announced buyback programs for the month of February. That is the second busiest month on record for buybacks of stocks. Tell you where we stand as we approach this final stretch for the week, and what a week it was. The Dow Jones Industrial Average right now down 81 points, sitting at 12,152. There's the chart, and there you see it is bouncing off of the worst levels, but nonetheless in red. NASDAQ right now weaker as well, with a decline on the session of about 25. We're looking at weakness in technology. I should point out that we've got some bright spots here. Dell Computer, for one, on the upside, one of the most heavily traded. S&P 500 chart looks very similar to the other two. Standard & Poor's also under selling pressure today, although just shy of the low of the afternoon. We've got all of the action covered. Our team in their spots right now. Bob Pisani at the New York Stock Exchange. We've got the NASDAQ covered and the NYMEX, along with our special guest. Bob Pisani, kick us off, our eye on the floor.
Well, this is going to be a very important last hour, because all day long we've been seeing how we're going to close today. Psychologically very important here. Here's the bottom line. We have been testing the lows, Maria, but on much lighter volume than yesterday. Exactly where we need to close, kind of debated, but the lows for the week closing below that would certainly be negative. Sentiment down here, mostly to the negative side. A lot of people feel that there's still a lot more volatility to come. The intraday lows for the week seem to be the most important numbers for most of the traders. 12,059 was the lows for the week for the Dow. That was yesterday. We're at 12,162, so we're about 100 points away from that. The S&P was 1381. We're a good ways away from that as well. As I mentioned, the likely path is more volatility. When I ask traders what's the single most important number next week, the non-farm payrolls numbers, because the economic situation in the United States, the job situation, becomes critical, supporting the bulls' idea that the U.S. economy is not slowing down. Right now, we're seeing some key groups that are weaker than they were earlier in the day. Take a look, for example, at material stocks. Steel stocks have been notably weak here throughout the day. That's perhaps not surprising if you're concerned about an economic slowdown, but we are not far from the lows for the day on steel and metal stocks. If you look at the brokerage stocks, they also have been moving towards the lows today. So stocks like Bear Stearns and Goldman Sachs, Merrill Lynch, Lehman also at the lows. Interestingly, consumer stocks are all down, so it's not like we're seeing a dramatic flight to a more defensive position. It's true stocks like Procter & Gamble, Altria, Budweiser are all down here, not quite as much as the rest of the market overall, but they are still to the downside. Again, the story is very clear this week, generally out of stocks and into safer situations like U.S. Treasuries. Let's go to Rebecca Jarvis. She's standing by over at the NASDAQ.
Thanks, Bob. Well, we are down here at the NASDAQ by about 1%, but let's put this into some historical context. Since the year 2000, there have been at least 25 worst weeks. I don't know if that's comforting, but let's look at the reason behind some of today's declines. Intel shares to the downside. They've been here most of the week. You see a lot of these NASDAQ heavyweights trading to the downside. Microsoft shares, very similar on that note. They're also down 0.6%, even though they got some decent news today. That same federal district court that told them they would have to pay $1.5 billion to Alcatel-Lucent over patent infringements. Well, today, a new patent was addressed in the court. It's a speech recognition technology patent, and it looks like it's going to fare well for Microsoft, that they won't have to pay anything on that. Oracle shares also to the downside by 0.1% today. The company bought, as we told you yesterday, Hyperion Solutions for $3.3 billion, and Hyperion Solutions today, bad timing, got a downgrade over at First Albany. Also, Google Google shares among many of the internets, all of the internets trading to the downside today. It's down 1.5% in late afternoon trading. And we'll just go to the good news for the end of this. Dell shares to the upside. Maria mentioned it at the top of the hour. To the upside by 0.6%. You know they reported earnings. Needham downgraded them. However, Merrill Lynch came out with a note saying that this might be a decent buying opportunity, that the shares aren't going to excite anyone necessarily in the short term, but that the company is working to improve its revenue and its earnings. And Palm shares, this is the big winner here today. It's up 9% right now. That is on some unconfirmed rumors that it could be a takeover target, and the companies that could take it over in that chatter would be Motorola, Nokia, and maybe private equity. So now we're going to head to Bertha Coombs. Just so you know, we are checking those rumors. Bertha?
Thanks very much, Rebecca. And on the oil and energy beat this week, it has been a wild roller coaster ride, a lot of volatility here as well. Here at the end of the day, we had a little bit of profit taking, breaking a 7-session winning streak for crude, finishing slightly lower, settling at 61.
Bertha, and it was a volatile week for Wall Street, to say the least. The S&P 500 is now on track to post its worst weekly performance in 4 years. Today's declines coming on the heels of 4 straight losing sessions in European markets as well. Asian stocks also posting their biggest weekly drop in 8 months. Take a look at where we are right now with the Dow down 78, S&P 500 down 11, and the Nasdaq off 25. Let's find out what's happening next week. CNBC's Melissa Lee with an early scoop on what's to come. Melissa.
Hi there, Maria, and it will be key to see whether or not investors continue their defensive stance. Perhaps what is most telling about what we've seen this week about the big moves is that Wall Street strategists have not been budging when it comes to their allocations. We haven't heard strategists getting more defensive, i.e. increasing their allocations to cash or bonds, and we have not heard anyone getting more bullish on stocks either. Bank of America, for instance, telling its clients that it is too early to increase its 55% equity weightings, which is below its benchmark of 65%, because valuations and earnings forecasts still appear vulnerable. There is still a tremendous wait-and-see attitude to see how deep this correction will go, although most say long-term fundamentals have not changed.
For something to derail this, it would have to be interest rates going up or else the economy going down because of a severe break in the housing market, causing the consumer confidence, the consumer spending, the consumer psychology to be very, very damaged, and for that consumer to retreat into his and her shell.
That's the long-term view. How about the short-term view? Well, investors, as I mentioned, are taking a more defensive stance when you take a look at fund flows. U.S. equity funds saw an outflow this past week, while international funds saw an outflow, and bond funds saw a bigger inflow last week versus the prior week. And we can also see this defensive stance taking place amongst stocks. For instance, take a look at these sectors. These are some of the hardest hit sectors, financials topping that list. And keep in mind, these are some of the sectors that have really led the markets higher. Merrill Lynch, by the way, estimating that financials accounted for roughly 31% of the market's downturn this past week, while tech drove 19% of the losses that we have seen. And on a sector level, we did see the defensive areas work like a charm. We've seen flows into these areas. Utilities, as you see there in the yellow, outperforming the broader markets. Healthcare, another defensive play that has worked. Merrill Lynch, by the way, overweighting healthcare, industrials, telecom, as well as consumer staples. So, Maria, while we are not seeing a big move in terms of allocations, we have seen a rotation into various sectors of the markets. We'll see if that continues next week.
Melissa, thanks so much. Let's get more now on what's ahead for the equity markets as we look to wrap up this busy week. Joining me now to talk all about what's ahead, Richard Sedmeyer. He's Chief Market Strategist with RightSide.com. Also with us is Hans Olsen, CIO, Chief Investment Officer with Bingham Legg Advisors. Gentlemen, nice to have you with us. Welcome to the program.
Thank you, Maria.
Thank you, Maria.
Let's talk a little about what may be the catalyst for next week. Hans, how do you position yourself after what has been a wild week?
You know, Maria, I don't think that we would do anything materially different at this point. Our view is that this has been a pretty healthy occurrence that's happened this week. It's sort of the equivalent of financial castor oil. It's an absolutely wretched experience while you're ingesting it, but it'll get you, make you healthier in the long term. So I don't think that we'd make any wholesale changes at this time. We'd stay with our current allocations, and we think that we'll come through this just fine. In fact, this is quite healthy.
And Richard, what will be the main catalyst in your view? Are we still looking at earnings, or are you focusing on the jobs report, or both, or what?
I think the job report is going to be kind of a non-event. We know there's going to be some weakening in the labor market because of the deterioration or the downtrend we've seen, or uptrend, if you will, in non-farm pay in the initial jobless claims reading. I'm really looking beyond that to the next major event being the Beige Book and just how weak the economy is from the 12 districts of the Federal Reserve System. I think there's going to be some significant weakness there in housing and commercial real estate and shipping and these kind of things that are going to start to filter through the economy and hurt the stock market even more. So next week could be a breather before we have another leg down to what I am calling a new bear market.
A new bear market. How bad can things get?
Well, you know, I think the bear market is the bear is just waking up from hibernation, and you know, the downside is significant. And when you see the convergence of all the different reasons right now, concerns, take it from Greenspan with the R word, and China and the carry trade. The real thing I'm focusing on is financial stress in the banking system. There is just so much residential construction loans on the books. These things are going to come to the fray sooner rather than later. Stress in the banking system.
Hans, what about that? We have seen the brokers in particular trade down in the last several weeks, and people worry about the liquidity story. You worried about the banks?
I'm not as worried about the banks. I think that if you look at lending activities amongst smaller banks, as well as some of the larger banks, you really haven't seen that roll over. So there hasn't been any real pull of liquidity out of the market at this juncture, and still the appetite for our securities by foreign investors remain healthy.
The problem with the banking system right now is when you look at residential construction loans, they're at $565 billion, up 25% year over year. And that is with the demand for houses down about 30%. That's the kind of stress that I'm talking about in the banking system. And even derivatives, if you look at derivatives, there's 132 trillion notional. And these are all under the hood of data that you find on FDIC.gov.
Right. At the same time, though, you are also seeing a pretty healthy situation in terms of liquidity and a healthy and very vibrant corporate sector, dividend payouts, buybacks, very, very strong. Hans, are you expecting the companies that have announced buybacks to do so as this is perhaps being seen as an opportunistic time with stocks down?
Well, I think that you'll continue to see buybacks. You'll continue to see an emphasis on dividends, and I don't expect deal flow, M&A activity to really abate very much because of this liquidity. I mean, I'm not Pollyannish about what could happen in the economy at all, or the market in particular. I expect that volatility will go up. That's healthy, but we also expect, you know, the GDP to be trundling along around 2.5%. Historically, when that happens, large cap stocks tend to do better than most stocks. And if in an environment where growth is scarce, large cap growth companies tend to do better. So it's all about getting good risk-adjusted returns. And you know, if investors start to focus on that more than just the upside of volatility rather than the downside of volatility, you know, perhaps we'll get to a better place.
We'll see about that. Gentlemen, thanks so much. We appreciate you joining us. We'll talk with you soon.
Thanks, Maria.
Meanwhile, the liquidity story certainly intact, and the deal making has continued even in the face of such volatility in the markets. According to Thomson Financial, last month was the best February ever for U.S. deal flow. That's when we saw a total of 731 transactions. Total value more than $161 billion. Last month was also the 12th best month on record when it comes to M&A volume in the United States. Also, Thomson Financial is estimating that deals last month will generate $3.66 billion in fees for Wall Street. That would be the 8th best month on record. And of course, that is what really has been driving the brokers, although in the last 6 months, we've really seen volatility there as well. A lot of these stocks are off of their best levels of the last year, and we are looking at a across-the-board sell-off today as well in the brokers. We've got 45 minutes before the closing bell sounds on Wall Street. Right now, the Dow Industrials are down 70 points. NASDAQ also weaker to the tune of about 23. It's a mixed dose, meanwhile, for Amgen today. Why is one analyst upgrading the stock in the face of major issues he calls for the biotech giant? Mike Huckman with the scoop up next. Then shares of Southwest Airlines could be poised to take off. Later on, a look at why now may be the time to add some shares of the discount carrier to your portfolio. We've got that story for you. After the bell, stay with us because proxy season is getting into full swing next week. One of Silicon Valley's renowned venture capitalists is sounding the alarm bells about what happens behind corporate boardroom doors. We'll tell you about it at 4 o'clock Eastern on the closing bell. But first, here's where the action is today on the exchange. The most heavily traded stocks at the NYSE on a Friday on Wall Street.
You're watching Closing Bell on CNBC. First in business worldwide. The